All right, folks, this is just a real quick discussion on order blocks, and we're going to look at an example from one of the Twitter followers in our group. And give me 1 second, make sure I can get this image up that he posted. Before I do, can you guys give me an okay on the audio? Yeah. All right, Peter, since I know you're on Twitter, audio is good? Appreciate that. Thank you very much. All right, I just want to make sure we're okay with showing. Should be seeing a chart that was shared by ProCharge Mopar. Are you guys able to see the chart? I mean, it's not my chart. It was a chart that was shared on Twitter. Can you guys see the chart though? I just want to make sure before I get started because I'm not really seeing my own feed. If the stream's broadcasting, I just need to know if it's showing the chart. Thank you for that, Arab Money Fund. Okay. All right, so the questions that were posted in this chart were germane to the British Pound USD 4-hour chart. And you can see some of the levels that are noted here are mentioned in the live sessions that we were doing this entire week. And I want to go in a little bit more detail as to what made them significant um, and try to answer the questions that were posed in this chart. It's actually a reoccurring question, and I'm going to try to do my very best to make it as concise as possible, but still, like everything else, everything's going to have to be weighed on an individual basis. So I'll give you the rules that I go by, and hopefully that's going to be a help to you. Uh, like I said, there's no panaceas, there's no be all end alls, but the things that I use, they serve me well. So hopefully, at the end of this presentation, you'll be able to get a better handle on what it is that we're doing. I know that you've worked with Chris. I've seen you in their in the Pro Traders Club discussions and such. I know you're familiar with some of the things he teaches. Um, if you suspend that just for a moment, everything that he shares, at least from the Pro Traders Club archive, let's dispel that for just for a second and only talk about what we see here in the chart here, and then I'm going to show you on my own MT4 charts. But your questions are, you've been studying these levels since 2008, and that's understandable because we've been in a relatively large trading range for cable. Um, can you teach that, or if it's impossible to know, is it the wick, is it the body, or is it the mean threshold or middle of the body of the candle that's sensitive? And it's all going to be linked to the time frame that you're looking at. In other words, the time frame that you're seeing the market structure you're trading in. For instance, we're going to use this one here um, because this is the actual chart that you pose the questions on. So I'm going to go over what I can go over in your chart here, and then I'll go over to the MT4 to kind of like make it a little bit more clear, because I can actually do something on that chart versus I can't do anything. This is a static chart, but nonetheless I can still communicate it. Now I don't know if my pointer is showing up on the stream. So what we're going to do is we're going to look at the examples from left to right. You got 4 examples here. So the farthest one to the left is you have up near the top of the high where it says the wick. And I guess the question is how would I know to anticipate the reaction at that level, at the wick low, and why not the body, and why not the middle of the candle? And we're going to talk about that example first. For instance, when the market made its low this week on cable, it started right out the gate, ramped up, had a retracement, and then rallied again right up into that uh, wick area you're noting. That was the order block that we were referring to in the live sessions as well. Um, because we had started the week below that specific up candle or bearish order block that you're noting as the wick on this chart, that would be an objective to get to. Okay, so I say this a lot, just because it's labeled or described as a bearish order block, it does not mean that I'm always going short there. It may be an objective for price, which is how we started the week. We were below that, and these were all upside objectives. So while it worked out in this favor, creating a high for the week, I had no indication going into this week that that would be the actual high of the week. You know, can these form like that? Sure, but it's not going to be something that you're always going to know right away, right from the beginning of the week. You're going to have levels to be watching for. So if you're starting below these levels and you're bullish, you use these levels, and the lowest one being the wick, obviously the low. Then the next objective would be the body's candle or opening in this case, and then the middle of that candle. Okay, so there's 3 levels you have here on purple. Again, I don't have an ability to know if you can see the actual cursor here, but I'll talk more about it when we go into the charts on my MT4 platform. But when we started out on the week, because we started below these levels up here, we look for those as objectives to either hopefully be already long and then take profits there. Okay, but you really want to be taking profits at that middle, I'm sorry, the bottom of the range, and not expect it to always get to the middle of the candle, because that's a lot of range it's already fulfilled by going up to that level. And if you look to the right of that candle, you've identified noted a question about it being the wick. To the right of it, there's all these lower highs that stops would have been residing above, and because that's all open space in there, it's like a whole lot of liquidity just waiting to be traded into. The only upside objective above that area of liquidity highs is that low on that up candle, and we know that the market is predominantly seeing smart money or banks, large institutions. They have to sell as the market rallies up. So the beginning of that selling program is always going to be delineated by the low of the up candle right before you see the down move. So again, I use the low of the candles if I'm bullish. Okay, on a bearish order block, I'm using that low as an objective to reach for, because price is going to want to try to get back to that. It's going to draw price up to it. It may just stop right on a dime at that low. Now, if you're exceedingly bullish on a particular pair, like say for instance the cable, say we were longer term bullish, and say that the everything else is, and all the internals, the dollar is weaker, we could be looking for another consolidation to rally up into that body's open on this candle, and then up into the middle of that candle, and then weigh out whether or not it has the strength to get through that for a continued move higher. But stripping all that aside, again, it's just you're using these things like no other uh, way of describing, except for like a Fibonacci level. Okay, when we do extensions, okay, for getting price objectives, you can use that same idea there. Like you have a 162 extension. Um, uh, well, I don't even know what off the top of my head. I can't remember what they are, but um, usually there's like 2 or 3 that we use. I think it's the, what is that? Good grief, I'm drawing a blank. 127 extension, 162 extension, and then the 200 extension. Okay, or a measured move type thing. Because these objectives are grades in terms of how far it can go. We don't know if it's going to be an exact measured move. We don't know if it's going to get to the middle of that order block. Because we don't know that, it's important to take that first hit at the bottom of the up candle, because it may be that's all that it has in it, and that's where the reaction is going to be. In this case, like I said during the live sessions, I really thought that we were going to hit that level, because I know a lot of folks, when they watch my videos, they want to know, okay, well, tell me what's going to happen. And we said that we were going to see that level hit on the upside, and if it had momentum going forward, we would see the middle of that mean threshold and the opening of that candle that creates that up candle up over here. And again, I don't know, I'm taking a lot of liberty here, assuming that you can see me moving the mouse around. The next one you have down here, the second one from the left, it says here the body held. That is inside of a large consolidation, all part of a market maker buy profile. And that's the fractal pattern that I trade with. We like to see that form with a consolidation, and it's a larger price pattern that takes into consideration that we're seeing accumulation in the market. And because this market has dropped down from that initial wick candle you've noted here, we went down, we consolidated, and then we have that one manipulation price swing that drops down and gets everybody thinking it's bearish. So the one in here where it says here the body held, all in that, I'm not really concerned about that. I'm not worrying about that level down in here because it's a part of a larger consolidation, and there's a lot of wicks in there anyway. So it's all reaching for stops. And if you combine that with the analysis on the dollar index, and you combine it with the euro pound analysis that we've been talking about the last couple of weeks, you have to wait for their, and you know this because you've worked with Chris. He teaches very similar things. You need to wait for it to expand out and trade at these extremes, not trade during, like in the middle of a consolidation, because if you're trading in the middle of consolidation, like this would be indicated here, you're near equilibrium. So when you have a near equilibrium environment like this, it can spread away a little bit and then come down, spread away on the lower side of it. I mean, you can see that by creating that next or third one from the left where it says when did why did price not go to here? This one here I can answer relatively easily, because this is the very low, or the smart money reversal pattern, that we expect to see in the market maker buy profile. You anticipate that to occur. When it forms, that low, or the bullish order block or down candle near the lowest low of the fractal pattern that we call the market maker buy profile, it will hardly ever, most of the time, it's hardly ever trading back down there. And because it's well, it's the smart money reversal. Only those elite that would know how to call that low, they're going to be in there participating, and you have that initial sudden punch away from it. It's not going to go back down there, which is the reason why we call it the smart money reversal. We have to wait for a higher low to form. Okay, the higher low to form, which in this case will be your fourth example where it says, why did the wick not hold here? Okay, now looking at that candle, and again, I wish I could know for sure you can see it, but the down candle right before the next leg up in price that you noted where it says, why did the wick not hold here? Cut through to the left side. Okay, cut through the left side of that all the way over here, even before your second example where it says here the body held. Go just to the left of that, okay, and you'll see the big down candle. Okay, see a big down candle in there? That down candle is the same order block that they're recapitalizing, where your last example is asking, why did the wick not hold here? See that? This smaller little candle that you're asking, why did the wick not hold here? That little bodied candle is inside the larger bodied candle on the buy side of the, the sell side of the curve before the lows actually form. Okay, so I'm going to go over to MT4 now and be able to explain it more. But these 4 examples, I might have to come back to this chart as I'm discussing it. But let's go over here real quick and take a look at what we got. Let me set my chart up real quick. Get a Virgin chart. Yeah, I think we got it now. All right, let me go over and switch us over. Yeah, you should be able to see it. Just confirm, if you would please, that you're actually seeing the 4-hour chart of my British pound. Guys able to see the MT4 version of the chart now? I'm just waiting for one of you guys to confirm it. Thank you very much, Peter. All right, so anyway, the question is when we're looking at this, we noted this level in the live session here, the low of this up candle. The low is the beginning of the sell program because that's where the algo will start. Because everyone's price is going to be slightly different because we're all getting data that's all chopped up and delivered in in all different ways, where everyone's broker's platform and every charting service you have, none of them are all going to agree. In a perfect world, we would all see the same low and the high and the opening and the close. It would all be the same. This is what makes Forex a little tricky because there's so many ways for us to disseminate the data that comes from the central banks. So therefore, we're going to have price action that's going to be slightly skewed amongst the highs and the lows. Okay, it's all going to have slightly different prices. It's going to happen, and that's why it's important. If you're going to learn from me, I tell you guys to use the MT4 platform for Forex LTD. Not that I trade through that brokerage firm. I don't ever tell anybody what to trade with in terms of brokerage firms, but it will give us all the same reference points. That way you can train yourself to see it, and then all you're going to do is apply that same stuff to your own charting service or how you trade or through who you trade through. But because the market opened up beginning of this week, right off the jump, okay, it went down, swept the equal lows. Okay, when it does this, this is a smart money reversal. This down candle at the lowest extreme will hardly ever, and ideally it never should be hit. It should never, ever, ever be hit. Reason why is because the largest introduction of buying is going to be down there. They're greedy just like anybody else, and they're going to buy a whole lot of it, and so much so that it's going to run away. It's going to create a secondary down candle or bullish order block. Okay, once you know that you need to anticipate this occurring. You just can't just indiscriminately just go and say, okay, I'm going to buy every down candle or sell every up candle. You have to have the context to expect this type of thing. And because we have, I'm going to divide this in half so you can see the buy and sell side of the curve. To the left of this low, okay, think about it. Smart money is a bank, okay? They're going to be hedging in. They're going to be buying early. They have very, very deep pockets. They can do that. So every down candle, okay, on the left side of this, that sets up a small little price swing on the upside, we always have to reference them because they're on the buy side of the curve, which is to the right over here after the smart money reversal. They're all going to come back to those same levels that's seen on the left side, okay? So you have to have a frame of reference that know that when they're down here dropping, when you see up candles after that, they bought in here. They're hedging. They're buying early. And here's some noise. Ain't worried about that. And come down here, we see another down candle, and then there's a reaction going up. So they bought some more. They started hedging in here as well. If you look at that occurring, we're going to extend that all the way through to the buy side of the curve. And by doing this, it really gives you a really richer view of price action that you can't get any other way. I mean, you have to be able to break down the data in the form that you trade in. Obviously, you can't just use one platform and assume that it's going to be the same price levels in all trading platforms. I mean, the wicks in these candles, I guarantee if we all put our 4-hour charts up, they're all going to look slightly different. Okay, but the down candles, when we divide this market maker buy profile, we had liquidity above these highs in here, which we noted these equal highs. We had liquidity above here, and this big liquidity void, which you know about because you've worked with Chris Laurie. This reference point is an upside objective. Should this get hit and we are exceedingly bullish, the next one will be reaching for this. They're just objectives. Then you have the mean threshold here. Okay, so they're upside objectives to the buy side of the curve on a market maker buy profile. Looking at the down candles, after you get a smart money reversal down here, and it's always going to occur after a consolidation, a drop down, which is like a Judas, just on a larger time frame. It's sucking sellers into the marketplace. If you identify all the down candles on the left side of the curve, okay, after prior to the smart money reversal, every time you see that buying occurring, all this candle here, that's the one you want to reference, because when you take the body of that candle and you extend it over here, it will be influenced on the buy side. It's not just always just hitting this one. This one's just going to draw your eye to it, yeah. But the way you want to look at how the large institutional traders are working themselves into the move, they price in and buy early. They're hedging. They buy it in here on down candles. They're buying. Remember, just like they sell on up candles, they're buying on the down candle. They're buying on the down candle, and this last one here they bought again. So I don't want to draw one off of here, but I'm going to draw the level out from that. It's how you interpret the profile. I'm going to have to choose a different color because it ain't going to work out well, is it? Let me see if I can show it with white. White might be a good one to show. Yeah, it's good. All right, so you can see if you've seen the video I had done for trading like the insiders using the COT data, I kind of gave you a really good depiction of how hedging is occurring in the marketplace, and you can actually see it with the market maker buy profile like this. When you see the down candle and a small move on the upside here, this is all hindsight looking. Once you understand what you're looking at, you're going to use the benefit of hindsight because it'll give you the actual buying points at which the large institutions are actually recapitalizing old order blocks. Because the idea is what? It's dropping down, okay, to get lower prices so they can buy it up and price it in, okay? So if they bought here, we know that there's going to be a reference going on this side of the curve that they're going to use to be repatriatizing this this order block. They bought it here before. Something fundamental's there. I don't know what that is. You don't need to know what it is. You just need to know, okay, they did some buying in there. Okay, so the body of that candle, we want to be watching that on the left, on the right side of that lowest low. Same thing in here. We have a down candle. Widen this one and not this one? Because there was no buying after it. It was just straight down. So we had a down candle and it started to go up. It only went up because why? There was some buying going on in there. Okay. Another little punch down in here, and it's up. The lowest one, price will not reach for that again. You need to look at the one that was prior to this lowest low forming. That's that last buying stage that they use to price in the low of the market. So if you extend the body of that candle through to the buy side of the curve, remember this is the curve here, it's divided by the lowest low or the smart money reversal in the buy profile. And I'm taking a lot of liberty here, expecting you know what those buy and sell profiles are. But using the open of that candle, draw it out in time. It doesn't matter if you're using the high or the body. Either one of them is so close in proximity, it shouldn't make or break your trade. But drawing it out in time, look at the sensitivity to it. It nails it right to the pip. See that? And not without any surprise, if you continue going through over here, it's also the mean threshold of this down candle. See that? And you can see all the bodies collecting around that too. Okay, so that's the level you're going to reach for. Over here, same thing. We just dipped into this candle here as well, which is another supporting idea why I was able to call the low on Friday, which it nailed it to the, I think it went 1 pip below it. I was looking for 144.80. I think it went down to 144.79 on the ask, but you know, we all can't be perfect now, can we? Looking at that though, okay, using your examples, the wick is going to be an upside objective. If we would have consolidated in here more, it could have punched one more time up into it. But it gave up the ghost. Once it hit that, it rejected and never showed a willingness to go back up there. So this up candle, okay, we go back to the beginning of the down candle. When it's violated right there. So we know this is a potential breaker. If this candle, it did indeed break this, yes, we want to wait and see it to trade down through it. And then this candle went right back up into it. That's your sell, the breaker, and sells off. And I know that's not germane to what your questions are, but I'm using supporting ideas to give you the reasons why. This candle here, you don't expect this candle to see a return back to that, because that's the smart money reversal. That's the least likely price point to see it return back to. You're going to see the very next down candle. This is a propulsion candle. It's the next higher bullish order block that sets another buying opportunity. Once a low is priced in, how do you know that? You have to look at the model, the buy profile, and study them enough to know that if it's trading down to a support level like it did in here, you have to expect that that's what you're going to see. This range in here may be filled in. The bodies of the candle all in here. Look at the bodies all that. It's a lot of price action around there. So yeah, this little wick might be, uh, filled in, but it doesn't have to be filled in, because look to the left of this up candle. It's still an up candle here. So this is an 8-hour candle basically together. You see what I'm saying? So this could be I can't show 8-hour candle on MT4, but this would be 2 4-hour candles. That's an 8-hour candle. And this would still be basically a small little wick below this opening of the the whole range of 8 hours. So we're looking at just this little area here. Uh, without without really saying anything to compromise Chris's stuff, kind of think of what he teaches in regards to what this is based on his stuff. I'm not asking you to talk about it, because I promise I would never show the things he teaches, because it's his stuff out of respect for him. But the idea is this whole breakaway of price in this area, when it comes back up to that level, that's what you would expect as a minimum. Okay, so that's an objective here. Once it trades back up and closes in all this open range in here, this liquidity void, that's all it was doing here, running up. It didn't do it here yet, did it? No, it just fell short of it. It still has a little bit of range still in here, and then in the next little drive up, it hits it. But this candle here, let me see if I can adjust it. There you go. This candle here, it's the open on this candle that it comes down and hits. But it's also the opening of this candle here, which means a lot more, because it's on the buy side. I'm sorry, it's on the it's on the buy side of the curve, right before the move starts to expand. So this is the expansion side of the curve. All this is early buying, early buying, early buying by smart money. They're all going to be recapitalized at a later time, and that's going to be acting like support, like a classical form of support resistance. This is support forming that will later be traded to. This is support forming that'll later be traded to. This is support forming that'll later be traded to. Okay? And if you look at a lot of the ideas that we're showing in the context of even smaller market maker buy profiles, you'll see the same phenomenon repeats. All the down candles right before the reversals, they're always going to be repatriatized after the lows formed. And we all chase these supposed patterns and Fibonacci's and all these other things, and it's not necessary. All you need to do is see where they clearly bought before and extend that through, and don't worry about cutting through candles. You need to cut through candles, because if you cut through the candles, it'll take you right to the context of what the market's going to do. It'll give you the right areas to be trading at, and you don't have to worry about Mickey Mouse in the whole, is it going to be the wick or the body, because it's going to give you a whole lot of insight based on what you're seeing over here with real buying. Why was this real buying? Because you can see it going up. Why was it real buying? Because you can see it going up. And then there's a low priced in here, and this whole range up here starts to retrace. You got to start considering these areas over here. And you know there's going to be a retracement of some sort. Okay, and this is the up candle after this one's formed. This is the one you want to be watching. This one here. But draw through the candles and see where the context is, where they bought before. And it'll support the idea of what you should be looking at. Between the wick and the high, okay, you got the opening at 44.06 and the high is 44.11. We're only talking about 5 pips there. If 5 pips is going to make or break your trade, you're probably trading with ultra short-term stops, and you're probably demanding absolution for your limits. And you don't need to do that. You could just simply just look at this. I would just look at this high and say, okay, at 144.11, I'd buy at 144.15. Because I know the likelihood of it trading all the way down to this candle is unlikely. That's not going to happen. And you don't really want to see it trade below the middle of this candle, because that's the mean threshold. You don't want to see it violate that. So just use what? If you use the close, that's 144. I'm sorry, 143.91. It's, what is that? 20 pips? Yeah, 20 pips or so. 23 pips, and that's within the reasonable level of 30 pips I use for a stop. And you can trade off the 4-hour chart and not even have to be down in those small little time frames, and you'd catch this move here. Hit it, bang, it explodes. So I wouldn't be concerned about, nitpicking about the wicks and the highs until you get a greater build a greater affinity for how we interpret, how I interpret institutional order flow. I can talk like this, and it sounds like cherry picking, but you guys know all this was in video format. So I know some of you probably are watching and saying, well, this sounds like you're just making it fit because it's hindsight. These are all things that were actually shown in. I even did the buy here early, okay, early in the week, and you guys saw that on Twitter. And that same 144.06 level was again sensitive here. Again, that's in Twitter. So those whole ideas were all, and all those things that I shared this week were all hinged on what I just showed you here. Okay, I just showed you here. You want to get used to seeing, when you anticipate a price move on the upside, you want to see a form of manipulation. That means they're going to drop it down away from a consolidation. If they do that in an area where you expect it to be a buy, that's like perfect. You want to see that scenario. And then you want to wait for the price action to run away. If that's what you want to be doing for high odds trading, and you don't want to be trying to capture the low, which is what I teach, don't expect that lowest down candle to be retraded to, because it's not going to. That's the same idea of thinking like classical support and resistance, where they use the lowest low of candles and expect it to trade down there, and then it's going to be a buy. No, it's going to be at a higher level than that level. It's usually going to be a one-stop hit, and it never goes back there. For instance, price hit up here, okay? If you use classical support and resistance, the idea is that we're going to sell up here. Or maybe you use the bodies of the candles, and that's your area where you're going to sell. That's still retail thinking. Institutions don't think up here. This is so far away from what they need. Okay, they don't want to take it up there, because some other bank may push price beyond that and collapse that. So they all work in concert. The low is the sensitive price point, because that's the beginning of the sell program that set this tone. So all you need to know is this is the objective on the upside, because we're below it. And this may be a factor, yeah, but like you said, you look at an 8-hour candle, 8-hour charts. I don't have the ability to show 8 hours, but between two 4-hour candles right next to each other, one 4-hour and one 4-hour candle together, the entire range would be the small little wick here, and up to this body's candle and this body's candle compressed together. This would all be one 8-hour candle, and it still would be very close to what you're seeing here in terms of the low. And this opening on this candle is not necessary, because look how much price has already been traded there. You see what I mean? So it's traded a whole lot in this little range between the opening of that candle and the low. There's a lot of efficient trading. It spent a lot. I mean, each one of these candles is 4 hours. So here's 4 hours, 8 hours, 12 hours, 16 hours, 20 hours that price has worked in that small little range. Even when it moves away from it quickly in here, it's already traded there so many times, it's not necessary for it to get back up in there with any great deal of magnitude. But it does have this open range from this area here where it broke away from. It traded up to it on this wick here, So essentially between this high of this candle and this up here, that was the only range it needed to fill in. And that's all you see with a little tiny little minute inerrant price action. Boom, right there. It moves 1 or 2 pips above that level and then gives out the ghost and trades down. I know it sounds, and when you're looking at it, you feel like you have to know, and you don't have to know if you know what you're looking at in terms of the institutional order flow. And what I was showing you this week, by taking the breakers on all the price swings, okay, and nesting them out, and you'll actually see the real underlying trend of the marketplace. You don't need trend lines, anything to do that. And what's great about it is it actually gives you the real buying points and selling points that you want to piggyback on. And if you do that, it's just like what I'm showing you here. It's all the same reference points. And once you see this low form and it runs away, then you know you got a tiger by the tail. Just go through the candles and find out where the buying was, extend that through, and they're going to be reference points that you want to be buying at. And if you do it at a specific time of day, which is London Open and New York Open, it's a loaded deal. How far is it going to go up? This little pocket right in here. This is the only exposed area that did not get filled in, right in here. The opening, I'm sorry, the high of this candle and all this little part of this body of this candle right in here. Why am I saying that? Because if we extend that over, that first punch up into it, it failed to get into it on this candle. But look what it does, finally goes through it a little bit right here, and then it goes down. So you know this. I mean, Chris is he's taught about this a lot in terms of efficiency and inefficiency. And this is the smallest little part of the inefficient portion of this range, because it's traded twice here. Sometime in here it did it, and in here. So in this little area, price has already been traded to. So this whole part in here is efficient. It's not efficient in here because of all the block of trading in here. It only went down through it here, didn't get any real opportunity to trade back up. And it would be nice if it would trade up to here. Then it would mean more. But the only pocket of liquidity that was left to be considered on the upside was this little range extended over here, and you see it go right up into it there, fill that in, and then it's free to move down. So as it relates to all these candles down here, go on the right side, I'm sorry, the left side of the curve, and use these reference points. Okay, you can do it with your back data. You don't have to do it on a live trading scenario, because it's better if you have a lot of examples showing what I'm showing you here. It's really clear. It's really clear. And you just reverse the same thing, just expecting it for the up candles when it's a market maker sell profile, and extend all these levels through, and you'll actually see what the real institution is going to buy before they even get there. You'll just sit back and you wait for it. That's what makes the whole thing that I do very boring, because I already know what they're going to do, and we just got to wait for it. You got to wait for a time of day to line up, and don't try with these real ultra short-term stops. And if you're trading with real short-term stops, you're probably looking for really small profits, and don't do that either. If you widen yourself up, deleverage, use like a 50 pip stop loss. Give yourself some freedom to get in. Use a real aggressive entry on your limit, and use a pretty wide stop. And then as you do these exercises going through it, you can slowly drop down in the time frames. I mean, 4 hours is pretty wide, but if you go down to a smaller time frame, like a 15-minute time frame, and use a market maker buy profile on it, you'll get really small entry opportunities, and your stops can be small there too, because by nature it's a smaller time frame. But if you're going to use a 4-hour chart to trade, man, you really got to give yourself some room. And I think it's fair to have a 50 pip stop loss if you're trading a 4-hour chart. And a daily chart, you could use as much as a 100 pip stop, and still have absolutely mind-boggling risk to reward ideas on those time frames, and not need to have ultra perfect entries. So it's not necessary to have the absolute, if it's going to be the wick, the open, or the middle of the body of the candle. But if I'm understanding you correctly, and you're trying to use it on a 4-hour chart, and you're trying to use really short-term stops and taking small profits, and I'm assuming a lot here, I don't know this for sure, but if that's what you're trying to do, then it's going to be problematic for you if you're trading off a 4-hour chart. But if you use a smaller time frame, you're going to find out that the wick to open, it's not going to be a make or break idea for the trade. And if it is, then you're probably either over leveraged or you're being unrealistic with your trade idea. You got to give it a little bit of room. But you can practice this on like 5-minute charts. There's a lot of market maker buy profiles and sell profiles throughout the week, and you can see what I'm showing you here. Even on that really small scale, you get lots of opportunity to trade these and practice in them, and it's amazing. It repeats all the time. But this is just one example. This is really a bad example because there's so many sloppy wicks in here. But nonetheless, the buys are where they are, and you can see them. You repatriatize them here, and we read down in here as well. And just while I got you guys, I just want to toss this in, and I hope this is helpful to you. I can give you more examples when we come back from my break, and we'll do actual live examples. You can actually see it happen. It's better to see it when it's actually happening. You'll be able to see what you should be expecting. And it's a whole lot more useful when I can do that for you and give you a frame of reference. But I called 44.80 as a low on Friday, and it was a combination of flout and Asian range ideas and projections, and what I just explained to you in reference to the market maker buy profile. There's 44.80. It's in video. You can watch it. It's the last video we have on the YouTube channel right before this one. I think I'm almost certain that's what it was. But yeah, price was hanging up in here, and we gave one more drive down. That's back when we were watching it live. I said that I was expecting it to go lower, and on Twitter I said I was done with it. And usually, like every other time in my trading, when I get out, if I waited a minute or two, I would probably get that last bit of a run. But I just learned to just be content with the majority of the move and be okay. But there's one more example for this week where I called the a major low, and not that this is a major low; it's only intraday low. But we gave the level intra week 146.60 as a level, and it pierced just by what? How much did it go up? No, it went right to it, didn't it? Yeah, it went right to it, 146.60. So yeah, a lot of consistency with it, and you're gonna learn to do very well with it over a period of time. But lighten up on your stops. You know, let's get a little bit wider with them, and be a little bit more aggressive with your entry, and allow a lot of fudge factor. And by doing that, warming up to these ideas and these profiles and looking at the order blocks, you'll know how to work with them. And I just can't explain it other than that. It's like a knack thing. I mean, I don't know how to describe it any other way than that. I mean, you'll know based on the time frame you're trading off of, if the wick or the body has been traded through before. I mean, think in the same way that the liquidity voids are used, and look to the left of why you should be buying it. I mean, there should be other reasons where they bought it before at that same area, and by breaking it down like that, you'll know right away if is it going to be a middle of the order block it might reach for, it's going to be the open of the order block or the close of the order block or the wicks. And really all you're trying to do is pick an area where you got the absolute highest probability of getting the trade on, but still allowing enough room for your risk to be in check where you can afford to take the trade, but still allow it to have a little bit of room and still not hurt you. And that's the art of trading, and you got to be able to manage the risk with the range that's needed to allow yourself to get in the trade and stay in the trade and not get knocked out, but also know when is that trade no longer valid. And that's the benefit of knowing the middle of the candle, because if you're buying the order block and it's a bullish order block, your risk should be limited just below that middle of that candle, because if it's good, it won't go down there. You see what I'm saying? So if you have that in mind, just go about get into the lower 1/3 of that bullish order block. If you have your stop in the lower 1/3 of the order block, then you're pretty much safe. And it's just reverse it for the bearish order blocks. But you got to get yourself in the trade, okay? And over time, you'll learn to pick better entry points because of the experience factor. But in the beginning, when you're practicing and you're taking these things as exercises and such, be very loose with your entries. Just use the first opportunity at the high. For a bullish order block, trade right at the high plus 5 pips. And it may trade down into the range, and you'll get experience, just like Chris gives you examples of doing exercises. This is one you got to learn to trade dynamically. Get in there and let it trade against you into the wick, and watch it as it dips into that order block deeper and deeper and deeper. And you'll know also when it punches through the mean threshold. Many times it'll bounce away from that and give you a favorable exit, and then you won't be able to sit in it for a bigger loss. It's all watching it live that gives you the input that you need and the experience that you can't get from just me watching. I'm sorry, me presenting a video and you watching it or giving you things conceptually. So you got to get in there and practice with it, and you're doing it. I mean, you're doing it now. You're telling me the feedback you're getting is sometimes your limit doesn't get hit or so, and that's probably because you're demanding something deeper in the bullish order block or bearish higher in the bearish order block. Just use the low on the bearish order block for your entry, and use the high for your entry for the buy on the bullish order block, and allow enough leverage to take the trade on. And if it's a bullish order block, put your stop in the lower 1/3 of the candle. It doesn't need to be below it. It doesn't need to be at the low of the candle or 10 pips or 20 pips below it. Just be in the lower 1/3 of that candle, and chances are you're probably not going to get stopped out. And if it does go down there, the probabilities of that trade being profitable anyway fall off. So you can actually look at it and actually collapse the trade before the stop even gets hit, so you can avoid taking a full stop. And that's all the benefits of watching this stuff real time. So I'm not sure if this is actually helpful to you, because it really is it's a sloppy example, but nonetheless it's good in a way that it's a sloppy example because it still shows that it works. But there's a lot of times when it's not that wicky in craziness in terms of volatility, and you'll see that the levels are so perfectly clear. You can see it. You can't escape it. So I'm not sure. I'm going to ask you if that helped you anything by presenting it. Pro charts, Mopar. Is that helpful to you at all? Awesome. I appreciate that, man. Thank you. All right, I'm going to get off here. There's a webinar getting ready to start. I'm going to watch it. So take care, guys. And I know this wasn't supposed to happen, but I had a couple minutes to take on the challenge. So hopefully this has been insightful to you guys, and wish you good luck, good trade.